Hi, everybody. This is Gary Dean, and this is our night video report for Thursday, March 9th, 2017. I'm getting this out about 45 minutes, 50 minutes before the market closes. I have to run out for a meeting, and I'm leaving in about 20 minutes, so I wanted to get this out beforehand. So we're seeing a little bit of everything today. I wasn't really, I was kind of up in the air with what today was going to be like because we were seeing some bullish divergences on the short-term charts. We did see a bounce off of the early trading, but then that got sold off again. And from there, we're seeing a bounce, and we're starting to. This is the resistance zone right here. So if the bulls can push it through it, then we're probably coming up, maybe closing this gap up at the 2380. But if they usually what happens for them to get through it is they gap it above. So we have the job numbers tomorrow. Maybe they do that. I don't know if the job numbers are bad, then we're heading down. But my main, I guess my main piece here is that tomorrow I would I wouldn't go in overly aggressive, but I would be very careful if I'm long, because especially if they bounce this into the close and squeeze out some shorts, that's going to leave the door open for them being disappointed no matter what the number is. Because if the numbers are going to be good, then there's really going to be no doubt that the Fed is going to going to raise rates next week. So I still think that and the debt ceiling are going to be a floor and a ceiling to this market. So if they decide to say jump it up tomorrow into the after the jobs numbers, I wouldn't be, I'd definitely be using that to short, but don't, go crazy. We have to see how they're going to run this into the Fed meeting, because a lot of times in the past, what they've done is, they kind of grind it higher, get everybody that's short all, kind of anxious. And then they give that quick little spurt up, wash everybody out, and then head down. So you want to kind of, you want to go into that meeting just relaxed and not, having to press one side. So my point would be, don't be over leveraged on either side going into it. Let things pass. We're getting into that time period that we're going to see a big move to the downside. So if they decide that they're going to try to run it up, use it to build a short position. Leave some say funds in the account to, if they decide to grind it up into the Fed meeting and maybe close this gap. But even if they decide to go higher than that, you just use it to short. It's just giving you a better shorting opportunity on it. But the first thing is first is the bulls have to get it through this area, and like I said, that usually the ways that they've gotten above any resistance has been to gap over it. So they have an excuse tomorrow to try and gap over it, and that would be the jobs numbers. But like I said, it's a very, very risky trade because this market's tired, first of all. And second, we're running into time periods that, they're going to catch a lot of people off guard. So that's one of the reasons why I'm kind of open-minded to see them possibly run it some, just because they're going to, if the big drop is going to catch a lot of people off guard, then that's the way to do it. But you want to keep some short, just for the sole fact that this can turn at any time, and it would make perfect sense. So you want to have some skin in the game. You don't want to be overly leveraged, just so you can go into next week with, okay, fine, if they rally it, then I'm going to use it to short. If they drop it, I'm going to wait for a bounce and add my short positions, or just run with position that I'm in. So this is the hurdle for the bulls. That's right in between this, let's say the 2365 up to the 2372. They have some resistance at the 2377, and then at the 2383. So these would, if they get above it, these would be the short-term targets. Above that, then they're coming up and probably closing these gaps right here. Now, this drop right here didn't give us any bullish divergences, but that's something on a short-term chart you don't really pay attention to, because the bulls don't really care about those. So one of the things that we're eyeing right now is, when is this wave 5 going to complete? Did it complete? Um, right now, I think it's probably we're looking at probably 70-30 that this is the top right now, and the wave 5 is complete. Now, what's the reasoning that it's not 100% is if you notice, this drop from this highs is right in between this the 23 and the 38% retracement. So that's typical for wave fours. So let's just take a look at the alternate count here. So again, we're waiting for this wave five, but let's say this count is wrong. I've told you guys plenty of times. So, Elliott wave is not my, say big thing in trading. I like to use it when I'm trying to find a turn. But so let's just say that this is all this. We have your 1, 2, and this is just a big wave 3. The alt would be this is a wave 3. We're making the wave 4, or they're going to come down a little bit more and then come back up. And the risk of this trade right here is, first of all, that we've already completed the wave 5, and this is just a counter trend bounce before we're heading lower. But even if it's not, we could see a double top where it's in that's where the alt 5 is, or even if it goes a little bit higher, the wave 5 is in, and then the larger drop is going to be pending. So I guess to sum everything up, no matter what they do here, have some short exposure because they could drop it at any point and make 100% sense. But if they rally it, don't go crazy on it because you just want to use that to add to your short position. And even if they make a new high, the bigger move is still coming to the downside. So you can see that they've they burned off the overbought levels here. So there's a shot that they are going to give us a bounce. But like I've said, we've been running in these overbought levels for so long that I don't believe it's needed. I'm trying to say don't get over leveraged on the short side because we know this market just from history tries to wash all shorts out before the larger drops come. So you want to just kind of stay ahead of them and say, fine, if you're going to do that, then we're I'm just going to turn around and use it to short. So finally a daily chart, you can see this was that oh my God, I don't know why I totally forgot the name of it, but it's a regression channel. I guess is it Friday yet? Anyway, so you can see when it got through it here, I was saying this is very, very overextended and it's not something that you want to be jumping on the long side. Well, we're right at the bottom of it. And remember what I've been saying is that this is really the area that the bears need to push through, and that's right around where we landed today, that 23.53. If they were to lose that, then we're going to get a quick drop probably down to this 2300 level. So you can see why the bulls are trying to hold this just to keep things going, but eventually they're going to lose all this, and that's when you start seeing panic, and that's when you want to be short this market. So I would, again, stay a little bit open-minded. Yes, we may be making an alternate wave 4, and we're going to get a wave 5 up that either tests or even breaks it a little bit, or we already completed it. So again, you want to have some short exposure, but you don't want to be over leveraged because if they bounce it, you want to be able to use that cash to build your short position on any kind of bounce. So let's see what they do with the jobs numbers tomorrow. Enjoy the rest of your night, and I will talk to you guys in the morning.